Well, good morning, everyone, and welcome to the second day of CORFAC International's 2021 Virtual Spring Conference. As you guys know, I'm Phil Crane, Providence Commercial Real Estate, CORFAC International in beautiful San Antonio, Texas. As chairman of CORFAC's Professional Development Committee, it is my pleasure to introduce this morning's keynote speaker, Scott Brown, Chief Economist at Raymond James. Scott will provide us with an economic update and insights on the commercial real estate market performance. However, before we begin, I'd like to thank our session sponsor and industry partner, CompStak. Devin Shields from CompStak is joining us this morning. Devin, would you like to say a few words?
Yeah, thank you, Phil. Appreciate you all having me. So yeah, my name is Devin. I work for CompStak, and I guess just a quick overview for those of you who don't know what we do. We are a completely free lease and sales comp database for brokers, researchers, and appraisers, and so it works, on a very different basis than maybe CoStar or some of these other services that you might be aware of out there. It's a barter system. You literally give comps to get comps back. And we cover everything from industrial, retail, office, other space like medical. And we're excited because we are moving forward going to be partnering with CORFAC, and hopefully we're going to be able to provide these resources to everyone that's interested in using a platform to get the comps they need, maybe in a more efficient manner than whatever current practices you guys use to get the information that you need for any given project that you're working on. But I am happy to take any questions offline if you have anything that you'd want to dive into in terms of what the platform can provide, and if there is anyone that's interested in getting a demo and they can't wait, I'm happy to jump into that as well. And so certainly let me know, and I'll put in the chat here. I'll just put my email and my number so you guys have access to that. But very excited again to be working with you guys in a closer fashion moving forward, and hopefully I'll see all of you in Detroit. I guess that would be the first in-person conference moving forward. So thank you very much, guys.
Devin, thank you very much. We're looking forward to that as well, and looking forward to getting some socks on, worn out the socks you guys give out. So looking forward to that in Detroit too. So.
Yeah, we'll have a bunch of socks ready to go for you guys. We've got actually some new socks that we just came out with. So some really exciting stuff on the swag side of the house.
And
very good. Thanks, Devin. So without further ado, I'd like to welcome Scott Brown. As Chief Economist, Scott provides regular economic commentary for Raymond James financial advisors and their clients. Before joining Raymond James in 1993, he served as Economic Research Manager for Pacific First Bank in Seattle and Economic Research Director at First Imperial Advisors in San Diego. Two pretty good towns, actually. Scott earned his PhD in economics from the University of California at San Diego. He currently serves on the economic advisory committees for the American Bankers Association and the Bond Market Association. We ask that you please share any questions you may have for Scott in the chat and keep yourself muted during his presentation. Now, please join me in welcoming Scott Brown.
All right.
Scott?
Good morning, good afternoon, depending on where you are. Happy St. Patrick's Day. This is my let's see, I've got some slides to share. Somebody needs to, okay, there we go. So I'll share my screen and find the presentation. And that didn't, hold on. Can you see my screen?
Yes.
There we go. So let's start from the beginning. This worked pretty well when we tried it in practice. All right. Since I am the chief economist, I'm here to talk about the economy. And this certainly has been an unusual time for the economy. Can you see the real GDP graph? Is it full screen? Okay. In comparison to what we've just gone through, top to bottom, fourth quarter to the second quarter of last year, we lost 10% of our GDP. That's just, we've never seen anything like that in terms of the magnitude and the speed. We've bounced back some, but are still not quite back to where we want. And obviously that's going to depend on the virus. In comparison, the financial crisis that we went through, we had a 4% decline. And that was over a period of about a year and a half to get down that far. And it took a while to recover. We anticipate that the economy is going to be probably back to the fourth quarter level of 2019, probably in the second quarter of this year. So it's coming back pretty strong. Obviously, this is all about the virus. You see back in April, we had the big increases in places like New York City. You lock everything down to give hospitals time to get the equipment, to develop treatments, and hopefully to get a vaccine. Kids went nuts in the summer, started to spread it around a little bit more. And then as we rolled into October and November, then you come in with a holiday season where people get together for Thanksgiving and Christmas. And we ended up with around 250,000 new cases per day in early January. And this was pretty frightening. And we thought this was likely to continue at a pretty high level. And that would essentially dampen economic activity. You did see some states restricting activity more. But instead, we saw a pretty sharp drop in the number of cases. It looks like we sort of flattened out. And the level here is still relatively high. I mean, consider back to where we were, last summer. We're still seeing over 50,000 new cases a day. So it's still pretty high. But the good news is, we've got vaccines that are showing up a lot sooner than we expected. I got my first dose on Monday, and we anticipate that we could end up getting most people vaccinated, by the summer, by May, late end of May, or even. There may be issues with new varieties of the virus. That could be a bit of an issue. We may have problems with people not getting vaccinated. Here in Florida, if you're looking to get vaccinated, there are couple different websites. There's the Publix grocery store. There's a state internet site. There's Walgreens, and what you find is that a lot of the doses are more available in the rural places up north, where it tends to be more conservative. So there still may be a lot of resistance to people getting vaccinated. The really bad thing is that we've had a huge number of deaths, more than 500,000 people. So this has been pretty serious. Bear in mind that U.S. population is 330 million or so, something like that. So this is more than 1 out of every 1,000 people dying because of this virus. So still a very serious problem, but it looks like we've kind of turned the corner here and the pace has slowed down. The biggest impact that we saw during the shutdowns last summer, obviously, was the big drop in employment. We lost 22 million jobs in March and April last year. That's just gigantic. And in fact, if you look at it across the income scale, those in the bottom 20% of income earners, 40% of those people lost jobs. So those are all service industries. They tend to be lower paying jobs. So many lower paying jobs were lost that it boosted the average hourly earnings numbers. It wasn't like people were getting, the wages weren't rising. It was just the fact that you're shedding all these low end workers. And a lot of that obviously was in the service industries, those people losing jobs. But even within industries, you had a lot of firms sort of cleaning house and get rid of people at the lower end. White collar workers were obviously more able to work from home, and that's a trend that is likely to continue. But you can see this rebound that we've had in jobs, and a little bit of a flattening more or less in the near term. The February numbers, I think, were a little bit depressed because of the bad weather. March, April, May, we should start to see a lot stronger growth here. So we regained some of the jobs, but we're still 9.5 million jobs below where we were in February of last year. Moreover, we'd be normally adding jobs. We probably would have added up to maybe 2 million jobs over the last year. So it leaves us about 11.5 million jobs below where we should be. That's a huge hole to make up. And that's, I think, going to be one of the key issues, is how we get all these people back to work and how we match unemployed workers to jobs. Now, this chart is a little bit busy. It's got the different sectors and non-farm payrolls, and it looks at the change in employment in February, April last year, the improvement since April last year, and then the February of this year over February of last year. So this is in total. So you can see 22 million jobs. We're still 9.5 million below, about 6%, 6.2% below. And then you start slicing and dicing, you find that all along here, every industry, every major category is still down year over year. The least hit was finance. The biggest was leisure and hospitality. We lost about half of the leisure and hospitality jobs in February, April of last year, and we're still down quite a bit. The other issue is state and local government. A lot of this is education jobs, but in contrast to all these other sectors that added jobs following the shutdowns from March and April, the state and local government was still shedding jobs, and again, a lot of those are in education. So state and local governments have balanced budget requirements typically, and when the revenues start to dry up, that means you're going to end up cutting.
You can't see it.
You can't cutting into muscle and bone. Can't see what, the chart? Or
looking at the real gross domestic product slide, which is the first one.
So it's not updating the slides?
Nope. No.
Oh, it says my screen is paused. I don't know why it would be paused here. Let me try this again. Share screen. Share. And all right, do you see the title slide?
Yes.
Yes.
Okay. All right, so there's the chart again. So what was I saying? You're still seeing weakness in further declines in state and local, largely because of the balanced budget, but a lot of this is education. In areas we think are strong right now, construction and manufacturing, you're still down below where you were a year ago. A little bit of this is weather for construction, but it's still going to be, I think, some time before we get back to the level of employment that we had before the pandemic. Now, the unemployment rate officially is reported at 6.2% for the month of February. And that really understates the degree of weakness in the economy. And that's largely because you've had a lot of people drop out of the labor force. There's a misclassification issue, which is maybe up to 0.5%, a percentage point in the unemployment rate. And you've had more than a million people now that are working part-time who would rather have full-time employment. So if you added all those back in, you get an employment rate that's a lot closer to 10% than the 6.2% officially reported. So I caution people not to put a lot of weight on that unemployment figure as it's reported. The employment population ratio, this green, gives you, I think, a better measure of where we are. You did get a big drop in the labor force. Some of this is early retirements, people deciding they're going to check out a little earlier. Excuse me. And those people may not come back to the labor force. So there's again, I think, a big question of how we're going to match unemployed workers for jobs, where we're going to find a lot of skilled labor. We still hear from a lot of companies around the country that they can't get the skilled labor that they need. There's plenty of unskilled labor at this point. So we still have a long way to go in terms of the employment rate. Well, what about income and spending? Well, you took this big hit. Now the blue is personal income excluding transfer payments. So most of it is wages and salaries, but there's also proprietor proprietorship income. So if you have a small business, that's included in there. It's dividends, interest income, all of that is included in there. So you took a little bit of a hit, pretty big hit in terms of wages and salaries. You bounce back some, but you look at the transfer payments, big up big last year, and then up big in January. And so part of this is the checks that go out. And most economists are really not that excited about sending people checks or putting money directly into their bank accounts. The studies I've seen, just looking at last year, about 70 to 80% of those checks were used to either pay down debt or added to savings account. They didn't really get spent. For a lot of people, it does matter. They will spend that extra cash. So economists really aren't excited about that in terms of the stimulus, but the public loves it. Politicians love it. In every recession, we get these checks that are sent out. The bigger impact, I think, is the extension of unemployment insurance benefits. So a lot of people that, if you were working part-time, if you had previously had your unemployment benefits exhausted, if you are self-employed, normally those people don't get to qualify for unemployment benefits. In this case, they did. And in addition, the federal government added on to whatever state benefits we were getting. So last spring and early summer, they were getting an extra $600 per week. In January, that went up to an extra, $300. So it disappeared for a while, but then it's back again in January, $300, and now that's going to continue through Labor Day. So there's a big chunk of change in terms of that extended unemployment insurance benefits. That's going to help those that are most severely hit by the pandemic. Well, people are limited in terms of their ability to spend on services. So that's where we had the biggest drop in consumer spending. A bit of a rebound, but it's not really going much anywhere. We expect to see, obviously, a huge rebound. People are going to want to go out to sporting events, music events. They're going to go out to restaurants. They're going to go to hotels. They're going to travel. All of that stuff. You got a lot of ground to make up. People are going to go nuts. One of the big lessons that we learned from the 1918 pandemic is that people they're going to make up for lost time, and they're going to be, really happy to do that. And one of the reasons we had the Roaring 20s was because of that 1918 pandemic. So the services are going to come back, but they're not, coming back right away because people have been limited in what they can spend on. You can't go to a ball game or, to restaurants as much as you did. People will find something else to spend money on. And what we saw over the last year was that they're spending money on durable goods. These are things that are going to last more than a year. Motor vehicles sales had been, are stronger than they were before the pandemic. Last summer, we were seeing increases in sales of RVs, boats, jet skis. All of those things have been doing pretty well. And then January, again, you get the extra cash. People are going to be spending more money. So as the service sector of the economy, begins to rebound, maybe this starts to moderate a little bit, but these are, pretty substantial gains. And we think there's a lot of income support that's going to continue to drive this. On the business side, if you look at just looking at equipment, non-defense capital goods excluding aircraft, it's a rough proxy for business fixed investment. You can see here pretty strong off the bottom. So businesses, I think, are pretty optimistic and they're buying equipment in anticipation of a stronger economy. You can see this drop here was not really all that big compared to the drop in consumer spending. And it was also much less than the drop that we saw during the financial crisis, when this was really kind of a credit issue. It was going to take a long time for this to repair, and it did come back eventually. This drop here is largely related to the drop in oil prices that we had. It's a lot of capital that goes into energy exploration and then the rebound there. But this is pretty strong. So we the business side of the economy looks to be pretty healthy at this point. And a lot of this is anticipation, and a big part of this anticipation, improved confidence, is coming from the fact that the COVID cases have fallen significantly from the beginning of the year. Vaccines are showing up much more earlier. The fiscal stimulus has been much larger than anticipated. So let's talk about the policy efforts. We'll talk about fiscal policy and then monetary policy here. The Federal Reserve was very quick to lower short-term interest rates a year ago in early March. of last year, we saw some disruptions in the Treasury market. That was deeply disturbing because the Treasury market is the most liquid market in the world. When you start to see problems there, that's a real sign of trouble. Fed lowered short-term interest rates, 2 intermeeting moves down to effectively 0 at 0 to 0.25%. And the Fed is now telling us it expects the rate to stay there for a while. Now, last summer, the Fed changed its monetary policy framework. And previously, the Fed's view was always that, well, you didn't want to push employment too low because then inflation would pick up. And if inflation picks up, then, the genie's out of a bottle. It's going to be much more difficult to get inflation back down. So the Fed would always act preemptively against inflation. Now it's changed its tune. It wants to have this long-term 2% goal, but that means that if inflation is below 2%, then the Fed has to allow it to be above 2% for a while. Now, there's no mathematical formula how high inflation could go for how long. It's still pretty much a judgment call. But the Fed is actually looking for inflation to rise a bit above 2% before it really starts to raise rates. And obviously, we talked about the employment situation. We've got a very, very long way to get back to what we consider full employment. So the Fed doesn't really expect to change interest rates. We will get a new policy statement this afternoon. Fed's not expected to change interest rates. It's also been buying $120 billion in securities. 2/3 of that is treasuries, long-term treasuries, and the rest is mortgage-backed securities. It doesn't expect really to change that monthly path until it sees substantial further progress towards its goal. So again, it's the employment goal and it's the inflation goal. You want to see inflation above 2% for a while, and you want to see the labor market a lot tighter than it is. Now, in addition to cutting rates and increasing its asset purchases, the Fed also relaunched a lot of the credit facilities that it had employed during the financial crisis. It created some new ones. And really it's been sort of pulling out all the stops to make sure that there is plenty of liquidity in the system, and that in turn has led to some concerns about inflation. Some of you guys, youngsters, may not remember this, but inflation was really high in the 70s and 80s. And economists will admit we don't know exactly why inflation picked up so much. We have a couple of stories, a couple of theories that we like to tell. And for me, it's the fact that you had the OPEC oil shocks, and so the price of oil went up, gasoline prices went up, the consumer price index went up. You had a much bigger union presence. A third of the private sector jobs, in the early 70s were union jobs. It's probably about 7% now. So the percentage of union jobs in the private sector are much less than they are. In the 70s, we used to have 300-400 work stoppages, strike activities per year, as they would ask for higher wages, more benefits and stuff. And now we get maybe 7 or 8 strikes this year, per year, and they're typically unions trying to hang on to whatever they have. So it's a much different environment in terms of the labor market. So boom, you get the oil price shock, gasoline prices up, the consumer price index up. Some of the unions had their wage contracts geared towards the CPI, like the Social Security is. They thought that was a good idea. So the union wages would go up, the non-union wages would follow, and then you have inflation embedded in the labor market. And inflation expectations are higher, and it took really the recession in the early 80s, where the Fed had raised short-term interest rates to really dampen down those expectations. And now, we've been sort of cruising back and forth, where inflation has been trending relatively low. And for the Fed, it's actually been a bit of an issue because it's trending below their 2% goal. And if people see that it's trending below their 2% goal, then they start to expect inflation trending below 2%. And so actual inflation is more likely to be below 2%. And that gives the Fed less room to boost the economy during an economic downturn. Now, some of the weakness we're seeing now in the inflation numbers is because of the way the Bureau of Labor Statistics looks at rents. The price of a home, mortgage rates, none of that matters in terms of the consumer price index. Because when you think about a home, there's two functions. There's the asset, which is going to appreciate in value over time. And then there's also the service that it provides, which is the shelter. So in terms of inflation, the BLS wants to measure that shelter cost, not the asset price. So they look at what's called the homeowner's equivalent rent. And that's a big enough share of the CPI. It's about a quarter of the overall CPI. It's about 30% of the core CPI. So excluding food and energy, it's 30% of that. And guess what? Rents have been seeing a lot of downward pressure, rising less than they normally would. And this has been a big factor. Now, presumably once the economy recovers, people start getting jobs again, and rents start to go up. So it may start to come back a little bit, but that's sort of been the story in the near term. So when we think about inflation, a lot of this is these fears that we're seeing now have really come up again and again and again. So I'm just pulling out the old playbook and just repeating what we know. At this point, we're likely to see a reflation. Prices that were depressed because of the pandemic are going to rebound. That's not necessarily indicative of broad-based pickup in the underlying inflation rate. So as we lap the low inflation numbers of a year ago, which we saw in April and May, you're going to see some pretty big increases, 3% year over year. That's nothing to worry about. It's not a sign that inflation's getting out of hand. It's just a sign that we're rebounding from the low prices that we saw during the shutdowns in March and April last year. When you look at raw material prices, yeah, they're higher. But it takes a huge increase in prices of raw materials to have even a small impact at the consumer level. Most of the consumer price index is services. Now, those raw material prices are going to matter if you're a manufacturer. You're going to be paying higher prices for your inputs. There are huge issues now with international trade because of the bottlenecks in shipping and so on. A lot of those things are going to take care of themselves over time. The supply chain disruptions related to the pandemic, I think, are going to be largely behind us. The U.S. economy looks like it's doing a lot better than other nations around the world. One important point is that government debt does not drive inflation. I mean, people kind of associate the inflation in the 70s with larger budget deficits, but we ran large budget deficits through the 1980s, around 5% of GDP or so. And, we actually had inflation coming down. Japan has a huge amount of government debt relative to GDP. It's over 230%, and they've been battling deflation over time. Now, for the Fed, or most economists, when you think about inflation, you're really looking at sort of trying to gauge the amount of slack in the economy, but you're also looking at inflation expectations, and inflation expectations are thought to be really behind the momentum underlying in the inflation process. So the Fed takes inflation expectations very, very seriously and is monitoring. Well, you can monitor in two different ways. You can ask professional forecasters or consumers or whatever, and this may be a little bit dated. You look at the long term, the green line here, so it's still pretty close to 10%. The 4-quarter ahead number should be a little bit higher now. I'm surprised that this last survey was so low. So, economists really aren't expecting an increase in long-term inflation expectations. Consumers maybe in the short term. You can also look at what's called break-even inflation rates or the tip spread. This is the difference between inflation-adjusted Treasury yields and fixed-rate Treasury yields. And what is that? That's telling you is you look at the 5-year period, and right now we're running on 2.5%. It's not quite the same as inflation expectations because there's a liquidity premium in treasuries, and then there's an inflation uncertainty treasury, but it gives you a first approximation. So yeah, inflation expectations were, this probably does reflect an increase in inflation expectations over the next 5 years, which is consistent with what the Fed's telling us. They want to shoot for a little bit higher inflation to make up for the fact that inflation has been below 2%. But if you look at, say, the 10-year horizon, and you can use that to back out what would the inflation rate be, from 5 to 10 years out. So the 5-year forward rate of inflation, and you're right back at 2%. So that's consistent with the Fed's view. They want a little bit more inflation in the near term, not a lot. You're not talking about 7 or 8% inflation, but then it's right back to 2% over the longer term. So that's exactly what the market's telling us. So all this fear, I think, has really been overdone. Certainly, you're not seeing those kind of inflation fears embedded in the markets, at least in the Treasury market. All right, so let's turn to fiscal policy. You've got this, a couple of relief bills early on last year, which really weren't much. You ended up with the CARES Act. And I think we were fortunate that last year was an election year, so you could get the two parties coming together and agreeing on doing an awful lot. The 2.2 trillion, that sounds like an awful lot, but bear in mind that the magnitude of that drop, the impact of the coronavirus was also pretty substantial. So that really, I think, helped kind of stabilize the economy last year. At the end of last year, we had the HEROES Act, which added another 900 billion, excuse me, and that included an extension of unemployment insurance benefits. And then now we have what's called the American Rescue Plan Act. This is the Biden 1.9 trillion, and I'm frankly amazed. I mean, we knew that the Democrats had majorities in both chambers, but they were pretty narrow majorities. I mean, you had 50-50 split in the Senate with the vice president, the tie-breaking vote. You had a narrower majority in the House after the November election. But they got it done. There were a couple concessions, but by and large, they got the 1.9 trillion. We didn't get an increase in the minimum wage, a couple other things that those on the left wanted. But it is pretty substantial, and most of this is going to fall this year. Some of it's going to extend into next year. And one of the issues that we have with this new administration is that they're looking back at the Obama administration and very unlikely to want to repeat the same mistakes. Now, a lot of economists were very critical of the Obama stimulus that we had. No Republicans in the House voted for that. 3 Republican senators voted for that, after they included some tax cuts, which really didn't help that recovery at all. But the idea, I think the criticism was that they should have really gone more for fiscal stimulus in the Obama administration. They should have gone for more for longer, and instead they started to consider austerity, and that dampened the pace of the recovery. In this case, they reached for a lot, they got a lot, and this is going to continue for a while. So one of the problems with fiscal policy, it's like building a bridge. You've got this fall off in private sector demand, so you have the government come in to support the economy, and then there's the private sector recoveries. Hopefully you get to the end of the bridge. So it's always difficult. How long should that bridge be? And in this case, I think it's going to be long enough. I think this is going to be pretty substantial. Now, through all these the support, you've got obviously spending on the virus itself, vaccinations, healthcare, all those kind of things. That's very important. You have the direct payments to individuals. We saw people's checking accounts have gone up last week. So even after the bill was signed, almost like the very next day, the money was going out. We've had extended unemployment insurance benefits. I think those have been very important. Some support for small businesses, some support for state and local governments. I think that's all important. And this, if you go on Wikipedia and you look at the American Rescue Plan, there's a lot of stuff in there. Some of it's going to be trickle up. There's extended child tax credits, a lot of aid, more to low-income households. And some of this may end up going on for a lot longer, the child tax credits in particular. And that's going to be, I think, very supportive for those households at the lower end of the income spectrum. You also have some increase in food stamps and everything else that's going to be beneficial. But what about the cost? You're looking at the Treasury budget as a percentage of GDP. This is so we're able to look at it over time, because normally everything's growing. If you just look at the dollar amounts, you're going to frighten yourself to death. But as a percentage of GDP, here's the financial crisis where we had this increase in spending, and then it kind of came back down and leveled out as a percentage, and then now boom, big increase last year. And this is before the 1.9 trillion. So this is going to be up here for a while. Again, that's very supportive. We had a drop off in tax revenues as well during the financial crisis. And there's a little bit of noise here, and a lot of this is because they delayed the tax payments from April to July last year, but not a big drop off in tax revenues, but still the huge gap. So you got a huge budget deficit. And if you look at the details, where's the actual spending going? You look at revenues as a percentage of GDP, and again, this is before the 1.9 trillion. So the numbers are going to obviously change, but it tells you what we were looking at. Revenues, sort of more or less stable. The big growth here is in what we call mandatory spending. It's or entitlements. That's the terminology. Don't blame me for calling it mandatory. That's what people call it. This is Social Security and Medicare. So yeah, baby boom generation is retiring. Medicare costs are going up. So that's where the big growth has been in the budget as a percentage of GDP. Defense, you may not want to do anything about defense. Interest payments, you can't really do anything about. So the green here is the non-defense discretionary spending as a percentage of GDP. It's up a little bit, but it goes right back down. Not especially large. You notice here the interest payments as a percentage of GDP, much lower than we were seeing in the 80s. And that's because interest rates are so much lower now. And in fact, if you look at the interest expenses projected over the next 10 years, they're actually lower now than they were before the pandemic. And that's because the outlook for interest rates is so much lower than it was before. So if you want to reduce the size of the deficit, that's fine, but don't do it right away because you're going to dampen the pace of the recovery. It's also not clear, how you're going to reduce the deficit. We were on an unsustainable track before the pandemic. We were running a deficit on the order of $1 trillion per year, and that was rising. We want to get that really back more in terms of stabilizing the debt to GDP ratio. And that means getting the budget deficit on the order of around nominal GDP growth. So if GDP growth is going to be maybe 2.5%, at 2% inflation, 4% of GDP, we could actually live a little bit with that. We could sustain that over time. The problem is you look at the federal debt held by the public. Now, a big part of the federal debt now is the debt that the government owes itself. Those are Social Security, Medicare, trust funds. So let's look back at the federal debt over time. World War I, World War II, yeah, those make sense. The idea is you're going to pay those off over a long period of time. You have the impact of the Great Recession. You got the Bush year or the Reagan Bush years here. You got the Great Recession. You got the pandemic. And again, this is before the 1.9 trillion. And then look what happens. Boom. And this looks pretty scary, but a lot of this is just the fact that the debt that the government has on its own books that it owes itself, the trust funds, over time, they're going to have to pay out of those trust funds. So that means they're going to have to borrow more. And that's what the real concern is. So when you look at the deficit, you want a large deficit right now. You want to ensure this recovery. We don't have to pay down the debt. Our kids or grandkids don't have to pay off the debt. They just have to make the interest payments and you have to be able to roll over the debt. The government has no problem borrowing right now. The bigger issue is long-term as the baby boom generation retires. Now, you could come up with, say, a pandemic that hits old people. So, it's maybe a missed opportunity. That's a sick joke. But, this is going to be the future. And there's really going to be a lot of tough choices. I mean, I think it'll involve some means testing entitlements. It'll imply some increase in taxes, maybe rolling back the cuts we've seen in the capital gains tax rate, for example. It'll, I think, also imply greater tax enforcement. That's one of the issues. We've had many fewer people working for the IRS. The audits have been down and so on. So that could be another way to raise revenues. But in short term, we've seen this rise in long-term interest rates now. And this has really spooked a lot of investors. Now, some of this may be due to these inflation fears that people are talking about. I don't really buy that. I think long-term interest rates are going to rise normally as the economy recovers. And if the pandemic is going to be behind us, then where should long-term interest rates be? Probably about where they were before the pandemic, maybe a little bit higher. So, I think we're going to see further increases. We do have the Fed meeting today, as I mentioned, no change in short-term interest rates. And if you look at the 2-year Treasury note, you can think of that as sort of a forecast of the Fed funds rate over the next 2 years. So the 2-year Treasury note is telling you it doesn't really expect the Fed to do anything over the next 2 years. The bigger issue today is, we'll get some revised forecasts for the Fed, a new dot plot, but I'm more curious about what's going to happen in the Q&A. Some reporter had better ask Chair Powell about this increase in long-term interest rates. They asked about it last week. Was it last week or the week before? And he was pretty nonchalant about it. He said, yeah, it's something they're keeping an eye on, that they don't really plan to do anything about. And it's not so much the level of interest rates or the fact that they're higher, it's the speed that they're moving. And again, if this just merely reflects a better economic outlook, that's not necessarily a bad thing. For banks, you lend long, fund short. This is, steeper yield curve is more encouraging for bank lending. So that's all, again, pretty positive for the economy. So when you put all this together, you look at a GDP forecast, here you got this essential rebound from the shutdowns that we had last spring. And even though most of the second quarter weakness really was in the March, April period, the economy was already rebounding in April, May, and June. And a bit slower, and then we do anticipate this picking up a lot more. In fact, maybe, we'll get back to where we were in terms of fourth quarter GDP, probably in the second quarter. And then we'll probably get back to the previous trend, even maybe a little bit above that at some point in the future. And this is going to be a tough question because the big issue, again, I think, is going to be matching people to jobs. So basic outlook, expecting a big rebound in consumer services. That's really going to be the driving force of the recovery from here. Labor markets, strong job gains, with some issues in terms of matching workers with jobs. Inflation, I don't really worry about too much. We'll see some reflation in the near term. Fed's still committed to that 2% goal over the long term. Federal budget deficit and debt, not really a problem in the near term. And you want to run these large deficits right now, but there are going to be issues longer term, how to get more control over the deficit. So you really worry about this later, not right now. It's not causing any problems right now. Interest rates, I think the Fed is going to be slow to raise short-term interest rates. Long-term rates normally rise as the economy recovers. Now, the Fed does have tools. If it thinks that this rise in long-term interest rates is too excessive, they can come in and shift their asset purchases towards the longer end of the Treasury curve. They can increase those purchases. There are a number of tools they have to push longer-term interest rates down. It'll be interesting to see if Powell even mentions any of those today. So for commercial real estate, just tying some of these issues in, one of the things we expect is that working from home is going to be a longer trend phenomenon, that people are going to be willing to work more from home. Some will go back to the office, but not quite in the same way. So particularly in bigger cities, you may not need as much support. You think of things like the food services for lunch, transportation, those kind of things. So you may not get a big rebound in those areas. And it's mostly going to have an effect, I think, in the large cities. There's some indication that New York City, if you're sort of at the lower end, white collar workers, those people may end up working online. The movers and shakers and white collar workers, those are people who are still going to want to be in large cities. In retail, we have seen this longer term trend of increased online shopping versus the brick and mortars, and the department stores have sort of taken on the chin now for decades. You had first that shift where people were shopping more at Walmart, Target, things like that, and now they're shopping more online. And even Walmart's doing a pretty good job of handling the online shopping. So that trend really accelerated during the pandemic, obviously, with people willing to buy more from Amazon and more reluctant to go out to bricks and mortars. We think maybe that trend starts to slow down a little bit, but probably still is going to continue, but not quite as steep as what we saw over the last year. And for malls, I think there's going to be a refocus in terms of getting people to the malls, more focus on food and entertainment. You'll still have some people, the discretionary spending where people go out and they browse shops and they find something that they didn't know they need, those kind of things. So, the retail is kind of a mixed environment. Warehousing, and the one area of strength that we're really seeing is warehousing right now. There is strong demand for warehousing, and a lot of it is related partly to the online shopping. And the other issue, I think, for commercial real estate is often bank lending. And I think the credit is likely to become more available. We're seeing signs for banks around the country that there is a greater willingness to lend in this kind of environment. And even with longer term interest rates, or probably because of higher long-term interest rates, you're going to see more credit being available. So that's pretty much it. And I think we can open up for specific questions if you have. I did leave a little bit of time here.
Yes, Scott, Rick Freeling in Little Rock. Quick question for you. Other than pandemic or COVID, do do you see anything on the horizon that could cause another big downturn in the economy?
Well, other than COVID, that's the one. I mean, if it turned out that these new strains of the virus are the vaccines are less resistant to these new strains, that could be an issue. If we don't get a lot of people vaccinated, that could be an issue, prolonging the recovery. I think in general, we're seeing a lot of states in particular moving perhaps a little bit too quickly in terms of opening things up. You still probably want to wait, because the virus isn't going away anytime soon. It's still going to be out there. And even if most people are vaccinated, it's still going to be a bit of an issue. So that's the biggest. In terms of the fiscal stimulus, that's pretty substantial. The monetary policy is pretty accommodative. All of that is very positive. Unless a nuclear weapon goes off somewhere, or the outlook is really promising. I think that's being reflected in consumer confidence, in business confidence, all of those kind of things.
Scott, this is Sim Dowdy in Atlanta. Where do you think energy prices are going to go? It appears gas prices are going up. We got the Keystone thing was canceled. Production was down for a while because people weren't traveling last year. So what do you see?
Well, as we often see in the early parts of a recovery, prices of raw materials, including energy, those prices will tend to rise pretty sharply. And a lot of it is because it takes a while to start ramping things up again. We've had energy exploration down. You've had some cold weather in February. That was a big boost to oil and natural gas prices. Those should probably moderate over time, although given the news from OPEC, I think oil prices are likely to stay relatively high, maybe $70 a barrel, West Texas Intermediate. So I think those are going to stay up there for a while, maybe even a little bit stronger, depending on how fast a lot of the travel comes back. There are a lot of empty airplanes that are sitting on runways that you can put back easily. It's getting the flight attendants and particularly the pilots, which may be a big issue in terms of ramping things back up. Similar with hotels. I mean, you got a lot of empty hotel rooms, but you're going to have to hire people to check people in, the receptionists. You got to train those people, and hopefully they're working on a lot of that now. So, but energy, I think, is likely to stay relatively high in the near term as the U.S. economy recovers.
Scott, it's Howard Greenberg in New York. I agree with what you're saying, that people will return to the office, but not in the same way. There's going to be all kinds of hybrid office versus work from home. There's a ton of sublease space out there, and there's a ton of space. For instance, in New York, we have a commercial eviction moratorium. So even when that's lifted, by the time landlords and tenants work their stuff out, there's a whole ton of shadow space in the market that nobody's going to know about. But the question is, when do you think the office market's going to stabilize? Is too strong a word, but we're going to see what the future trend is going to be. How long do you think that's going to take?
Well, I don't think it's taken long at all. I've talked to some economists in New York, and a couple of months ago, I mean, there were already, the management was coming in and sort of dividing up the office space and sort of trying to clean house, figuring out what they were going to need. When the office contracts or whatever come up, they're going to need less space. So a lot of that is being worked out now. I think in smaller cities where commutes really aren't that big of a deal, the office space may come back a little bit better. But places like New York, I mean, I know people in New York, typically commute like an hour one way in and out of the city. And why would you want to do that anymore if you can work from home? So you may go in, Friday, take a hotel for the weekend or something like that, see a show. But I think, a lot of that office space is just, the demand is just not going to come back. I was seeing in Japan, they've got a lot of excess office space, and they're converting some of that into apartments. I
Oh,
don't know if you're going to get much of that.
I hate to interrupt, but I think that's the stupidest idea because the dollar cost of doing that, forget about the fact that these buildings are not adaptable. The dollar cost of doing it would be beyond incredible.
Yeah, again, I wouldn't expect it, but you know, like here in Florida, I live 11 miles away from the office. I have been coming into work. There's nobody here on this floor, maybe one or two people, you know, I may see. You know, that works out pretty well for me. So for smaller cities, maybe, you know, if your commute's not too bad. But I think this is going to be a big issue. There are also really big questions about how this ends for you know, residential real estate. You know, when you have all these moratoriums ending, you know, if the rents have sort of been building up, you might not have to pay rent, but it's sort of building up, and you might have to try to make good on that. You know, there's a potential for a big mess at the end of that. And you know, the same is true, I think, in terms of commercial office space. So there may be some problems. There may be some firms going out of business, those kind of issues. It's going to be messy, I think. But you know, the overall economy, I mean, it's going to be, I think, good enough to offset those kind of issues in the aggregate. So it might be sort of a local problem, a unique problem just to, you know, certain you know, office leasing companies or whatever, but not a systemic problem to the overall economy.
Hey, Scott, Sim Dowdy again, Atlanta. So the big elephant in the room is we're spending 1.9 trillion. They're talking about spending 4 trillion more. How are we going to pay for it?
Well, you know, we're borrowing right now. And one of the issues is that the Fed has certainly been siphoning off a big chunk of it. Fed's buying, you know, $80 billion in treasuries per month. It's not clear where Fed may actually even end up increasing the amount of purchases if they think they need to keep long-term interest rates down. I don't see inflation as being much of a problem. You know, we're not monetizing the debt. Yeah, the treasuries that the Fed is buying, you know, those don't go away. They aren't vaporized. The Fed still owes them, and they still have to be rolled over. And the Fed is going to probably end up reducing the size of its balance sheet over time. But you know, there's plenty of time to work this out. Again, I don't lose any sleep over the budget deficit in the near term. I think the bigger questions are long term, and you know, they're going to involve tough choices. You know, are we going to have tax increases, more tax enforcement? I think is biggest. And we also have what's called tax expenditures. There's all these little things in the tax code. If you do this kind of behavior, you get a tax break. Those things are actually even more than the amount of spending that we had, you know, pre-pandemic. So, you know, there's a lot of savings that we could do in terms of getting rid of a lot of those tax incentives at the federal level. We have a debate now in terms of this 1.9. You know, there's money that's given to the states, and the states are all saying, "Oh, well, we get to do whatever we want. Let's cut taxes." And the administration saying, no, that's not what the law says. So there's going to be a little bit of a hashing out of that. And I don't think, you know, we're going to get the tax cuts at the state level. But, you know, things are fungible. That is, you know, you could end up with, you know, some of the money going to, you know, roads and bridges or whatever that the state would have done anyway in order to keep taxes low. Those kind of things. So, you know, there's some long-term challenges, and it's going to happen. You know, at the state, federal, local levels, budget deficits are going to be a big issue for a lot of reasons. But in the near term, I think, you know, you want a strong economy, and a strong economy really kind of helps the situation.
This is Marcus from San Francisco with TRI. I had a quick question for you. Pre-COVID, a 28,500 stock market was considered a bubble. How do you feel about 33,000?
Well, you know, I think, again, the biggest change that we've had since the start of the year was the number of cases started the year very high. Number of COVID cases have been falling pretty rapidly. The vaccines are arriving a lot sooner, and the fiscal stimulus is a lot larger than we thought it was going to be. So all of those things support a stronger economy. So that means more revenues. Now, when you think of the value of a stock, it's, you know, theoretically you're buying a discounted stream of future earnings. And those earnings, you discounted them with an interest rate. So if long-term interest rates are going up, then that discounting is getting more significant, and so the price would be lower unless the earnings are rising more rapidly. So for the value stocks, that's the case. While the earnings outlook, especially the near term, is improving faster than the interest impact. For tech stocks, you're buying a tech stocks or really growth stocks in general, you're buying really more earnings somewhere out in the future. That's where you expect to see the bigger increase in earnings. So the long-term interest rates rise, those earnings are getting discounted more heavily. So it's going to, long-term interest rates actually have a bigger impact, I think, on tech stocks than growth stock or than value stocks right now. I think that's more or less what's going on. I don't think, the signs that I've seen that the market's really that overvalued, and we may get a little back and forth. I mean, we're certainly going to be prone, I think, to some corrections here. Not necessarily a full-blown bear market, but I think, again, there's a lot of optimism out there.
Scott, good afternoon. Ed Bean from First Capital Property Group down in Orlando. Thanks so much for your time today.
Sure.
Picking up where Sim questioned, the 1.9 trillion, the 4 trillion that's in the works. You mentioned the government is buying, T-bills and things of $80 billion a month. Is that coming out of the TGA account that Janet Yellen is talking about quantitatively easing? And what if so, when that balance comes down to zero? I mean, are we going to be able to buy anymore? Where is it going to come from?
Well, the Federal Reserve, it's sort of quasi-government. It's responsible to the Senate and to the American people through that, but it's run independently, and that's especially important. Now, when the Fed buys these Treasury securities, also buying mortgage-backed securities, it buys that with money that they create out of thin air. And I get emails from people saying, well, how can they do that? I can't, buy stuff with money that I create. And well, that's what the Fed does. The Fed normally does, open market operations. So you're the Federal Open Market Committee. It goes out and buys treasuries. And when it buys those treasuries, it does that with money that it creates. It's just doing it at a much larger scale right now. And that's not necessarily inflationary. A lot of people look at sort of the monetary aggregates are really, when the Fed looks at inflation, they're really looking at sort of pressure within resource markets, capital, labor, raw materials, and the raw material prices I mentioned aren't really that big of a concern. The labor market is the widest channel for inflation. We still have a long way to go to get back to full employment. So again, it's money that the Fed that creates out of thin air. They did this during the financial crisis. They do it in normal times. They're just doing it at a much larger scale.
What about taxes? They have to be going up.
I think taxes are going to have to go up at some point because, again, you want to get yourself back on a sustainable track. And, could just be rolling back the capital gains taxes, increasing tax rates at the higher end of the income scale. I think that's part of it. Tax enforcement, as I mentioned, is a big issue. There's talk of a minimum tax, not just in the US, but worldwide now, because there's some people in some industries where you've got the tax laws arranged so that you don't pay any taxes at all. And we've seen this from a lot of US corporations, that even before the corporate tax rate was cut, a lot of them weren't even paying much taxes at all. So there would be a minimum tax for corporations to pay. I don't know how much traction we're going to get from that. It's very difficult to raise taxes. Certainly Republicans are not going to vote for any sort of tax increase. So it would be up to the Democrats. And if we see the filibuster go, or at least get reduced, which is what they're talking about now, that may make that a little bit easier to raise taxes. But I think most Americans don't begrudge people's success. They do want people to pay a fair share, and the tax rates. The Warren Buffett line that it's not really fair that he pays a lower rate than his administrative staff. I mean, it's just,
he does not volunteer to pay more now, does he? Though
he doesn't. No, and I don't know anybody who would. I mean, we all love tax cuts, But, everybody does worry about the deficit. I think it's gonna happen over time. I don't necessarily think it's going to be a big negative for the economy.
So guys, we're at an hour here. Scott, we appreciate your time. Does anybody else have one more question? Hearing none. Again, Scott, we appreciate your time. Devin, we appreciate you guys sponsoring. Does anybody else have any other comments at all? Jonathan, staff?
Just one, Phil. I think it was an excellent presentation. Just a ton of practical information crammed in here. Very good.
Thank you.
And
Thanks, Howard.
Thanks everyone for being here. We'll do it again tomorrow, 11 o'clock, same time. CRE deal making session. And all of these programs will be recorded. So once they're all complete, we will send all that out to everybody in CORFAC Nation so they can listen to them again, share them with folks, and all that good stuff.
Just one more comment. I really appreciate our president being very serious out there.
Professional.
And that's not. And
Thanks for winding things up, Joe.
First time he's been muted.
That's our sleepy Joe.
All right. I was going to be quiet today, but since you called me out, God.
Well, why not?
These are my St. Patty's Day glasses. See? Well, again, thank you everyone for attending today. It was a great session. Absolutely fantastic information, Scott. Thank you. And as Jonathan said, join us again, same time, same place tomorrow for another great session. And thank you all for
Thanks, guys.
Thank you.
Thank you.
Scott. Thanks,
Thank you,
everybody.
guys.